Good morning, and thank you so much for joining us on this Monday morning. I hope everyone had a lovely weekend. How lush was the weather? So while we wait for people to join us, feel free to pop in the chat. Obviously, if we were at a face-to-face event, we'd all be able to network and kind of get to know each other. So rather than miss out, feel free, pop in the chat, say hello, a bit about your business. You can put your contact details in there. Also, tell me about your weekend. Did you do something slightly different? Obviously, the weather was so nice. I mean, I must admit, my partner and I, we washed our cars and we got excited because it was something different rather than a walk and doing the limited things we can during lockdown. So yeah, feel free, pop in the chat function. So let's go with Emma. What did you get up to at the weekend?
I spent the entire weekend in the garden and I painted the fence as well. So getting all the jobs done that I haven't done over the winter and have been thinking I can't wait until it's warmer to get outside. So finally got some jobs done out there.
I love that. And you're starting to see like the first signs of spring with the flowers pop up, which is lovely. Ralph, what about you? What did you get up to at the weekend?
Well, most of my weekend I spent watching Julie put all her clothes away because we're doing some improvements above the garage, and so we're having to move everything. So other than our normal cooking and watching some TV and having some chilling time, that was the big thing this weekend.
Love that. So for those of you who have just joined, feel free to pop in the chat function, say hello, tell us a bit about your business. Feel free to tell us what you did at the weekend. I'm always up for some new ideas that we're allowed to do. So yeah, I'll kick start. I'm just conscious that we've only got an hour and I want to give as much time to Emma and Ralph as possible. So thank you so much for joining us. My name is Kayleen Harrington and I'm the events manager for the Norfolk Chambers. I hope you're enjoying our offering of virtual events and thank you again for attending. You can find our full offering of events on our website. I'll put a link in the chat function, so feel free to view these after the webinar and book on any. They are completely free to attend. So, PIPSI, 5 steps to planning your finances. PIPSI is an anagram used when planning your finances to determine your priorities. Protection, income protection, pensions, saving, investments. In this 60-minute webinar, Ralph Hunt and Emma Knight, financial consultants at Face-to-Face Finance, will walk you through the process of using PIPSI to take stock of your current financial position and plan a way forward to achieve your short, medium and long-term financial goals. You're welcome to ask them questions during the presentation, but the live Q&A will take place afterwards. So please use the Q&A function when you have a question. We'll also be using the poll function, so you're in for an interactive webinar. So Ralph, actually, before I hand over to Ralph, we've also got Lizzie on the call. She's just shadowing me because moving forward, she'll also be hosting Norfolk Chamber events. So that's why you'll see her name there. So Ralph, over to you.
Thanks, Kayleen. That was a fantastic introduction. That's pretty much saved at least 10 slides that we're going to be using today. So without further ado, we will go to the agenda, and we're going to just give you a brief introduction about us. We're in the main going to be talking about PIPSI, and finally what does an advisor do and how that actually works with us. So for anyone who hasn't met me before, my name is Ralph Hunt and I used to work for an American Express company called Acronyms. I then went on to Friends Provident, and finally since 2003 I've been at Face-to-Face Finance, and as Kayleen said, I'm an independent financial consultant.
Morning, I'm Emma Knights. I've been in financial services for almost 9 years now. I started at Norwich and Peterborough Building Society originally, moved on to Money Facts, and then I joined Face-to-Face Finance in 2018, where I've qualified to be a financial consultant as well. So a little bit about us, who we are at Face-to-Face Finance. So we're based in Cringleford, just outside of Norwich. We're completely independent financial advisors. We're directly regulated by the FCA and we're not part of any bigger network. We've been established for over 15 years and we work with lots of other introducers as well. So solicitors, accountants, will writers often refer clients to us to be able to help them with their financial needs. We also have another company, a sister company called Face-to-Face Estate Planning, where we can also write wills, trusts, lasting powers of attorney to help our clients and give them an end service. So what makes us different to any other financial advisor? So you've probably seen before that we wear slippers. We don't just wear slippers because we're working from home. We wear them when we're in the office too, because it's been proven that you're much more productive when you're wearing your slippers, and it is just much more comfy as well. So we do that. We have our own podcast called Your Recipe for Financial Success, where we talk about lots of different topics. So you can listen to that on Apple or Spotify if you want to. And we have a Facebook group called the Money Compass, which was a community that we've set up so people can go in and talk about their finances, ask questions, and it's just a really safe, friendly space to have a chat with people about different things. But one thing that's really unique about us is our clients would never know that we've gone on holiday. So if someone phoned up to speak to me or Ralph and we were somewhere else in the world, they would just be told that you'll get a call back within 24 hours. The office would send a message through to us, giving us all the details, and we'd give that client a call back from wherever we are. So we're only a phone call away wherever we are in the world. So PIPSI, financial services uses lots of different acronyms, FCA, FSCS, IHT, FOS, there's all these different things, but what do they really mean? So today we're going to be talking about just PIPSI, and these are the 5 steps to look at for planning your finances, and you need to look at each area one at a time. So if you look at the first one before you move on to the next one, so it's almost checking the coast is clear before you move on and then following the process through. So I just wanted to let you know that I have definitely spelled PIPSI correct through this presentation. I haven't just misspelled Pepsi. I'm not talking Pepsi. We are definitely talking PIPSI today. So just want to make sure that you knew that I could spell. So hopefully moving on to Ralph.
Okay, thanks, Emma. And our first port of call whenever we're dealing with a client, even if they've come to us for a completely different reason, we will always check this area out. And that is the area of protection. And in this particular case, we're looking at life cover. This is really the the building block of client protection. And as you can see, there's lots of different sorts, from whole of life to family income benefit. And each of those will do a different job. And we call that the 3 Ds. Now, the 3 Ds are very important to us because they give us a reason of why we're actually looking at them. And the first one is debt. We would look to see what would happen if a client was to die, what debts would be left either to their family or to other people. So I'm now going to ask Kayleen to put the first poll question out there. And if anyone can see that, if they press what they think is the answer. Yeah, and here we've got 61% thinks that, or 19% of people think that 61% is the answer, but in fact it's 42% of people don't have life cover. So the answer is 42. So 42 in every 100 people with a mortgage do not have it covered. So who said this was going to work perfectly, Kayleen?
I'm always positive. If you put your scanner or your mouse, there you go, and then click on it.
Perfect. It's so good having built-in IT people here. So the next area we're looking at is dependence. And generally speaking, there's two lots of dependents. Normally it's children. So we make sure that if someone's got children, that should anything happen to the husband or wife or whoever, that those children are not going to be have financial hardship. And the other group of dependents, and this is occasionally, is if you've got children who spend money looking after parents, and again, should anything happen to the children, then the parents would lose out. And finally, we have the people from HMRC, and this is normally death duties. So it's normally our last port of call whenever we're dealing with inheritance tax. But you can actually take out an insurance policy that on your death, should there be an inheritance tax bill, it can be paid for by a life assurance policy. Now, as you can see, there's quite a few different types of life cover in the previous slide. But also there's quite a few different scenarios, and each life cover does a job on its own. We also look at funerals now. It's becoming a bigger and bigger part of our industry because people want to organize things themselves. A lot of times they're much happier knowing that their funeral is paid for by a policy, and they're going to have the send off that they want. Along with most of these policies, either as a standalone policy or as an add-on, is critical illness cover. I think it's a great policy. It's because a lot of people nowadays with modern medicine are actually surviving. So you can have cancer, a heart attack, whatever. Imagine all after that, all your financial worries being got rid of, mortgage paid off, have enough money to live on, which will allow you to recuperate and recover, I believe, much easier than if you were not only in that position of having a health worry, but also the worries about, well, you know, could I lose my house? What happens if I lose my job? And so on and so forth. So it's a good cover to have along with that. So I shall now pass over to Emma to explain the next part.
So I is for income protection. It's also known as permanent health insurance, and one that's quite often forgotten by a lot of people, I think. So income protection would be used if you are ill or injured and you can't go to work for whatever reason that may be. And it's a policy that you can put in place to have a regular income paid out to you. So some people are really fortunate and will have sick pay through work, so they could get kind of 6 months full pay, 6 months half pay, but much beyond that, not many employers are going to cover you for. And what happens if you can't ever return back to work? You're not going to get kind of state sick pay forever. You may be able to get some other benefits, but it's going to be a very low level of income maybe. So every year, over 1 million people in the UK are off sick for more than 1 month. So it's something that's really important to have covered if you don't already have other provisions in place. So Ralph mentioned earlier about cancer, and 1 in 2 people are now diagnosed with cancer. And the people having cancer leads to around about 25% of income protection claims. So it just shows that something that's so many people get, it's really important to have something in place to protect you. So there's lots and lots of different reasons that somebody could be off work. So you might think something obvious, something physical you can see. So if someone falls off a ladder, falls down off a tree, or whatever it may be, or bad back, it's quite obvious that somebody's physically hurt themselves, and that's the reason they can't go back to work. But I think mental health and being stressed in the workplace is a much bigger thing now than it ever used to be, particularly with lockdown and people being affected in different ways. Being off with stress and mental illnesses is now leads to 29% of claims. So it's even more than cancer. So it's a huge kind of proportion of claims. So hopefully, Kayleen has our next poll question for us though. So I've given you a few clues about what claims are, but what do you think the top cause of claim for all income protection claims is? So mental health, cancer, or the word that I really struggle with, so I'm going to try and get it right, musculoskeletal. I hope that's right. If not, someone can correct me later. So which do you think it is of those 3? And hopefully we have some answers coming up soon. Awkward moment to see if anyone's actually voted for us. Someone said done, so it looks like it's coming. So you're not quite there. I obviously misled you there with the cancer, but actually the word that I can't pronounce very well, musculoskeletal, is the top cause of claiming on income protection. So obviously lots of people are self-employed that do physical jobs, so it's those kind of people that tend to take these policies more so and have a higher uptake. So it's those physical injuries and bad backs and sitting at desks and things that are going to be where the claims are. So income protection can replace up to 70% of your income. So they don't replace 100% of your income because they still want to encourage you to return back to work. And it can pay out until you reach state retirement age. And you can have it so it covers your own occupation. So me as a financial advisor, if I couldn't return to work as a financial advisor, I could claim on this policy. But it's also really, really flexible. So if I couldn't say return to work full time and I could only come back 2 days a week, you can use the income protection to top up your income for the remainder. And all the benefits you get are tax-free. But I thought I'd just tell you this because I found it really, really interesting. I had a look to see what the longest ever income protection claim was. And it's actually LV that are paying out this claim. They've been paying out so far for 32 years, but it's still in payment. So the member that had the policy had a stroke at a young age, have since been diagnosed with epilepsy. And so far it's paid out over £300,000. So bearing in mind that it's been paying out for 32 years and it's still got some time to go. This person was relatively young, so you've got to imagine the premiums they paid are never going to equate to £300,000. So they've had their fair share of income from this policy, and has obviously helped them to keep going through life because otherwise they may not have had any other income. So hopefully Ralph has the next one for us.
Yes, I do. And the next P is an old favourite of ours, pensions. The reason why they come up in order, because obviously you need to look at the life cover, you then look at need to protecting someone's income, and then pensions. Because of all the goals that people have, as an advisor, this one is really, really important, because you can retire still with a mortgage. You can retire with a car loan. You can retire in all sorts of ways. But when you consider the age that people now are living to, retirement is bigger than any time that you ever spent at school. And it's pretty much equal to your working life. It's not super unusual for people to have been retired 30 odd years. So pensions to us are very, very important. And it's someone getting the right retirement planning. Anyone who's listened to me before would have already met Sydney down there. And you've got a couple of photographs of what I call traditional retirement, someone on a cruise and someone sitting there in after a walk in a park. But more and more often now with people, they need more flexibility, because a lot of people love their job, enjoy what they're doing, and they don't ever want to retire as such. But they want to reduce their working week, and have more flexibility, or they want to have the choice. They get on really well with their boss. They're more than happy doing the job. But if that boss was to retire or change, and they didn't like their working environment, they like the idea of just being able to say, no, I've finished. So we actually have to take all that into account. Over to Amy.
So, thank you. After we've looked at the protection in your pension, we then have a look at savings. So when we're talking savings, we're talking emergency funds and short-term savings. So when we think of an emergency fund, we think of up to kind of 6 months of your income. And short-term savings, we're talking things in the next couple of years. So Christmases, any holidays that you want to go on, if you plan to get a new car in the very near future and you're saving up for that. So we're talking kind of very, very short-term goals. And we all know at the moment, savings accounts don't have the greatest interest rates on them. Bank of England base rate is at 0.1% at the moment. So you're not going to be getting a huge amount of growth on your savings accounts. So that's why people tend to look at investing anyway. But you may have heard talk of negative interest rates on the horizon. Let's face it, we can't go much lower than 0.1% without going to negative. But it's not going to be a great thing for savers. It'll be something that borrowers are going to really enjoy though. So Denmark have already got their first negative mortgages. Their 10-year fixed mortgage is currently at minus 0.5%. So if you were to borrow £100,000 over that 10-year period, you'd only have to pay back £97,500. So it's going to be really good for borrowers, but if you're saving, you're going to be paying to keep your money in that bank account. Now, whether that be a fixed fee each month or each year for having your money in a savings account, or a percentage, we'd have to wait and see what the UK brings to us. But negative interest rates aren't going to help savers. So some of our clients already choose to use premium bonds for their emergency savings and short-term savings. So they're very, very similar to obviously a bank account. They're fully protected. You can have access to your money, but there's not a regular kind of interest rate or return that you get on these. What they have is a prize rate. So the prize rate is currently at 1%. So what does that actually mean? So if you have premium bonds, will have a 1 in 34,500 chance of winning £25. Now we have clients that win the £25, even 50 or 100 on quite a regular basis, which can lead to kind of a nice return on those. But imagine you were that 1 in just over 50 billion that won the £1 million. I think that would possibly be well worth it. So a lot of our clients see that as worth taking a chance that they're not going to get a lot in a bank account, a deposit account at the moment. So they might as well take the chance of either getting absolutely nothing or potentially up to £1 million return. So see what your chances are, see if you takes your fancy. So that leads us on really nicely to the next one, which is another I, but this one's for investments. So once we've covered all the previous areas, we've looked at savings, we've got your emergency fund sat there just in case we need it, we'd start to look at investments. So that on the screen here, we've got a few different types of investments. So ISAs and bonds you might have heard of, single company shares, but some of these you may not have heard of. So structured products, VCTs, EISs, gilts. But all of these would have a different reason why you'd use them. And they're all a completely different level of risk. So some investors would be very, very cautious and be worried about what would happen to their money invested in the stock market, whereas others are prepared to take a lot more risk and they've got the capacity to do so. So what are some of those reasons that we might use these different types of investments? So it would be based on your particular circumstances and your goals. Are you planning to invest for your children's future? Or actually, some people come to us and don't really have, they have a spare amount of money, whether that be a regular amount or a lump sum, and they're looking for somewhere that is going to get a greater return than a bank account. So they don't necessarily have a certain, I want to use this money for X, Y, Z, but they know they want something better for it. It may be you're looking for tax efficiency. So some people aren't too worried about the tax they may have to pay, but others, it's really, really important to them that they pay as little tax as possible. Now, I know which one of those people I'd be, but everybody's different. It's looking at the access that you require. So some people will need to have access where they can get to this money every now and again. Some people might not need any access at all, whereas others might need regular access and monthly income even. And allowances and limits. So some people, for tax planning and different things, we need to make sure that we take advantage of all the allowances and limits that you can with different types of investments. But another is old age care planning. So something that people don't really think of, that why would you plan to go into care? Well, not many of us would plan to go into care, but how are we going to fund it? And that's what we're planning for. So products like bonds we tend to use for older people or people going into care. So we can use bonds in that area. And inheritance tax planning. Now, nobody plans to pay inheritance tax, but we can do planning to reduce the amount of inheritance tax that you may have to pay. So it's using those different types of products that are best suited to your circumstances within the level of risk that you're prepared to take to achieve what you want to.
So what do we do as advisors? Well, as we've said in previous webinars, one of the most important things is goals and priorities, making sure that the clients are happy with their own goals and their own priorities, and they understand the consequences of what they're doing. An area that we look at that's important is the review of existing plans and policies, because what you don't want to do as an advisor is upset or change anything that's really good that a client has. So doing a double check is important. And also it's understanding different life stages for different people. And we pretty much have 5 life stages at Face-to-Face Finance. If you look at number 1, the starter, they're going to be looking at more protection-based help and possibly savings at that particular time of the circle. And as they get on and they grow into their jobs, they tend to get more money, whether it's through inheritance or actually earning, because they'll be coming into their peak earning years, and they'll be saving more, planning for their future. And then eventually they'll become what we call a number 4, an accessor. They'll be wanting to enjoy the fruits of their labour over this time, and as they go on into life, and we've got clients that have reached the magical age of 100. They're going to want to be able to preserve that, to hand it down to the next generation. And it's our job to make sure that all these things that clients want happen. Emma said that about reducing inheritance tax, that can be reduced or it can be got rid of completely. And it is down to planning and what we can do with them. And one of that areas is by identifying shortfalls in a client's life as such, and making recommendations so they understand what's going to happen. Also, the consequences of action or inaction. One of the things we use is a cash flow analysis. It shows what happens if someone wants to increase their pension or if they want to take money early from their pension. We have clients that understand the importance of it. And every now and again, you'll have a client who wants to put a gravel drive in, but wants to then take the money out of the pension without actually understanding the consequences. Emma and I went out to see a client a couple of years ago now, and he wanted to take money out of his pension for a new kitchen. And we ran a cash flow analysis for him. And the upshot of that was, not only did he not take the money out of the kitchen or out of the pension for the kitchen, but he actually increased his monthly payments because he understood consequences of actions. And the most important thing that we do, and this is why we as a company always look for long-term relationships, because we know this works, are regular reviews. I've never met an unhappy client that has regular reviews. We get lots of new clients, and when we ask them if they've seen an advisor on the regular basis, we pretty much know the answer before we've started. And the answer is no. So regular reviews are vitally important, because things change in people's lives. Now, as an advisor, we give regular reviews. We also make recommendations. And like I said, we point out the consequences of action or inaction. A few years ago, I went out to see a gentleman, and he wanted to do a £50 a month savings plan. And I was quite happy with that. I was going through our fact find, taking notes. I found out that he had a wife, had a young child, and I found out that he had no life cover. And I said, well, do you want me to look at that? And he said no. And I said, well, what are the consequences if you die? And being quite young, he said, well, I'm sure they'll get by. I won't die, and everything will be fine. Now, in the recommendations that I wrote to him, my first one is not to do the savings plan, but actually to take out life cover. And he didn't want to do that, so he went ahead with the savings plan. and unfortunately he died. And that put quite a strain on his wife and obviously their finances, because they didn't have the mortgage cover. They didn't have anything. And what happens is that actually affected both her parents and his parents, because some of their retirement planning went on looking after their daughter and their daughter-in-law as such, and the child. Now, I'd done my job. I'd actually said, this is what you need. You need life cover because you have a definite shortfall. But I want to explain this in a slightly different way. And when I was teaching this to Emma, I said, you must have heard about the pig and the chicken. And obviously I knew she hadn't, but this is the pig and the chicken. Now, the pig and the chicken are both farmyard animals. And the pig and the chicken are looking over the fence one day, and they see the farmer having the breakfast, and he's having bacon and eggs. And the chicken turns to the pig and says, well, isn't that fantastic? Look, we supplied that for the farmer to eat. And the pig, and pigs are very intelligent, as most people know, turned to the chicken and said, well, it's okay for you, because that's just part of your everyday routine. But for me, it's life and death. And that's really, as advisors, we see lots of clients in different stages. And it is something that we love doing. But we will point out consequences of actions because it's something that we do day in and day out. But for clients, it is life and death. And it is making sure that everything is right and working correctly. And that's why reviews are very important. 20. Now, 20 isn't a special number, although it is actually one of my favorite numbers. But 20 is all the acronyms we've used today. So without further ado, is there any questions from anyone?
Thank you so much, and apologies if you can hear any noise in the background. My other half has decided to start the decorating while we're live, so there's not a lot I can do about it. Just apologise and tell him off after this. Thank you so much, and I'm so sorry that I messed up your hangman. I mean, I was really excited when I saw the slide briefly, but didn't put two and two together. So yeah. If we don't get many questions, I think we're just going to have to play hangman to see if people paid attention to what you've just presented on. So just to remind people, if you've got any questions, feel free to pop them in the Q&A. If not, the chat function is absolutely fine. So while we wait to see if any questions come in, how much should someone put in their pension?
Go on, Emma.
Me, okay. So it entirely depends. It really depends on what you want to get out of your pension as to how much you should put in. So it's going to be a different answer for absolutely everybody. And also it depends where you are in your life cycle. So me being obviously the young whippersnapper that I am compared to Ralph, the amount that we'd have to put in our pension if we were both starting from the same position, wanting to achieve the same outcome, would be very, very different, because I've got a greater period of time to be putting that money in, whereas Ralph, I hate to say it, has got a much shorter period of time. Obviously the grey hair gives him away. So it completely depends on your own circumstances, but it also depends on what you can afford. So we're not by any stretch of the imagination saying that you should put every single penny that you've got into a pension, because that's not the case. You've still got to live for today, but you just need to be conscious of how much you're putting away for your future and how much you are going to kind of achieve in your retirement. So that's why we use kind of the cash flow analysis planning to be able to show you on an annual basis, this is where you are, this is what's going to happen if you can continue to do what you do, to be able to show what that future outcome could be.
Thank you. And would you recommend, if people have got, obviously people change jobs every now and again, or maybe on a regular basis, depending on who they are, if they've got multiple kind of pension pots, would you suggest kind of amalgamating them into one or keeping them separate, or is that more a case-to-case basis?
It is quite a case-to-case basis. It depends what you've got and who they're with. Especially kind of older pensions, they can have lots of unique features in them, where if you move them, you lose those features and benefits, which could be really beneficial to have in the future. So you need to be kind of cautious of it. A lot of the newer kind of auto-enrollment pensions, where people can end up having a few £100s if they move from job to job regularly, those ones can obviously still be consolidated into one. You should still kind of review them to see what they've got in them, but they can quite often be consolidated into one pot.
Thank you. So Nigel, I'm going to kill my other half. So Nigel says, what about relevant life cover as protection?
Relevant life cover can be a good type of protection because it's normally paid by a business. So you get tax relief on it, depending on how it's set up. It can be quite complicated to be done, but yes, it's a good form of life cover.
Perfect. Thank you. Just seeing if there's any other questions before we close. It is 10:42, so I'm waiting to see if we've got any questions, but I'm also going to check that people are paying attention. Now, I'm not going to ask Ralph to go back to his hangman slides, because then you'll be able to see the answers. So feel free to pop in the chat function. We're going to go through the different letters of the anagram PIPSI. So can anyone remember what the first P is? Feel free to pop in the chat function. Also, if you've got any questions, pop them in the Q&A. So Nigel's coming straight away with protection, which is correct. We'll move on to the second one. So that's I. This is a 2-letter word. So does anyone remember what the I stood for? Again, feel free to pop it in the chat function. Nigel, again, income protection. Thank you.
Nigel was on the board.
I know. So then we've got the next P. So this is all the rest are single words. So again, anyone remember what the second P is in PIPSI? Lizzie, love it. Pensions. We've then got the S. So can anyone remember what the S is within PIPSI? Nigel, well done. Yep, savings. And then the last one that we went over, I say we, I didn't, Ralph and Emma went over shortly, is the I. So can anyone remember what the I stood for? Yes, investments. Well, Nigel was clearly paying a lot of attention. I can't check anyone else's. I know Lizzie was as well. So just checking, if anyone's in the middle of writing a question, just let me know in the chat function. If not, we'll look to finish the webinar early to obviously give you some precious time back. Or you can just take it as a 15-minute break out of your day. You know, we're here to help you as best that we can. So we've got another question that's come in saying, how do you know how much life cover you need?
It's really, you need to look at your own situation and think forward. So if it was life cover because you've got children, you would normally work on the youngest child's age, and you would think what's going to happen in the life. So if you had a mortgage, you would almost certainly want that paid off. If you think, well, did I go to university? Do I want my children to go to university? You'd take that into account possibly. So you would look at when do you want the cover to end? So you would maybe go until your youngest one has left university. You would think of things like holidays and school trips and shoes and all the clothes and everything that you could possibly think of. And then you would look at the types of cover that's relevant to them. Some are more cost effective than others. So let's say you had an amount that we'd worked out that you needed £300,000 worth. So on day one, if you died, you needed £300,000. Or on day 2,000 days down the road, do you still need £300,000? Or would they be better having an income coming in every year that would pay all the bills? So actually nothing necessarily got paid off, but an amount of money to pay the mortgage, to pay for the holidays and those. So it's picking the right amount over the right term and making sure it's the right policy or policies, depending on, because what a lot of people don't realize is if and I'm being slightly sexist here, that if it's the lady who's staying at home looking after the children, which is still the most traditional way, if they're not earning, it's almost as though they're not contributing to the house, but they are by a huge amount, because, you know, someone's staying looking after the children, and you know, basically worth a fortune, but you still have to take that into account and put a monetary amount. That's the thing about life cover. It makes everything into pounds and pence, but to get there you need to think about the emotions and what's happening to work that out.
Thank you. We've also had another question come in saying, how does your cash flow planning work? What information would you look at?
That's a little bit of a piece of string question, because it depends on what we were doing for the client. So whether it was someone just coming to us who immediately wants to retire, or someone coming to us who've got a particular goal. And I'll talk about retirement. So let's say a client or clients came to us, a husband and wife, and they only had a pension, then we would look at that purely on the cash flow analysis. But we would say things to them: do you want us to take into account state benefits? Do you want us to take into account premium bonds? Do you want us to take into account a buy to let that you've got? So it's all the things that can happen that we can take into account. But again, on the regular reviews, we constantly rerun it because things change. You might have a buy to let one year that you're thinking, no, I'm going to keep that. But for various reasons, people do sell them. And they might say, no, I've no longer going to have that income, but I've got this amount of capital. What can we do with it? And obviously, as Emma quite rightly said, the return on a premium bond is going to be different than a potential return on an equity pension or ISA, and we would take that into account again with the cash flow. So I'm not really sure if I've answered the question or just said it really depends on what they want to achieve, what they've got in place, and what they want us to use.
Thank you so much. We've also got a question from Sylvia that says, what if you're refused life insurance, e.g. on medical grounds? what would be the best way to protect yourself, to cover for critical illness, etc.?
It's very difficult if you've been declined. First of all, if it was one of our clients, we would look into it to find out what the decline was for, and then see if there's any specialist, because every now and again we will be able to find a specialist that no one else has been able to cover in general terms. And if ultimately they're declined, then we would then look at their own scenario and say, this is what you could do. You could do this or this. But we would also go back and re-look at it on a regular basis, just to see if there's been any changes in the market.
Thank you. So just checking if there are any other questions coming in. Just to let you know that I will be sharing a copy of this presentation along with the recording as and when it's available. I've also popped into the chat function a link to the event survey. It only takes a couple of minutes. If you could just fill it in just to help us develop our virtual event program, that would be perfect. So I'm not seeing any more questions come in, but if they do before we close, then of course I'll ask them. So it's just to say thank you so much again for joining us on this Monday morning. I hope you have a fantastic week, and we will be seeing you again for one of our virtual events. Emma and Ralph, did you want to say a final farewell before we sign out?
We do. Well, I do. I would like to say a final farewell.
Thank you for listening to us today. It's been lovely for you to join us.
Thank you so much. Sorry, I'm just checking. No questions. No, it's just people saying thank you so much. So Lucy says, thanks, Kayleen, Ralph and Emma, a very useful session. And Sylvia saying, thank you, Ralph and Emma, for an informative event. Perfect. Well, thank you so much. Enjoy the rest of your week.